trying to setting up the YouTube link. Okay. So good morning everyone once again. And you're welcome to another edition of our lecture on strategic financial management. In our previous lecture, we were solving a question and we didn't complete that question that day, right? And I said today we'll continue from where we stopped. So before we continue from where we stopped in our previous class, so let me quickly do a brief recap on investment appraisal, right? Investment appraisal is one of the functions of a financial manager, is to make an investing decision, to make an investment decision. And as a financial manager, you need to identify a project that is viable, that will maximize the shareholders' wealth, right? Then, in doing that, there are different types of decision, right? Where we have the divisible projects, we have indivisible projects, we have dependent. Of course, we know that divisible projects are projects that can be undertaken in part. Indivisible projects are projects that cannot be undertaken in part. Right? Dependent projects are projects that depend on each other. Right? A depend on B, and project C depend on C, D. I'll still explain further when we get to capital rationing. Right? So, and a mutually exclusive project is part of capital investment decision. Mutually exclusive means that two projects that serve the same purpose. Either you undertake A or you undertake B. They serve the same purpose. And I equally explain that in investment appraisal, there are two methods. There is traditional approach and as well as the modern approach. Right. Now, for my explanation, I said the traditional approach, right? It is when we have the payback period, and the accounting rate of return. The accounting rate of what? Accounting rate of return. Right. And which all this does not consider the time value of money. Right. Then I explain further that payback period, the decision is to choose a shorter period, right? To choose a shorter period to recoup back your investment. Then accounting rate of return make use of accounting profits. Make use of accounting profit. And accounting profit is is subjective. Now, when an accounting profit is subjective, if you want to determine the accounting rate of return, it is the average profit divided by the average investment. Now, the average profit is the total profit made for the year divided by the numbers of years, while the average investment is calculated as the initial investment plus the scrap value plus the working capital divided by 2. We give you the average investment. So the accounting rate of return, what is the decision under the accounting rate of return? Is for the is when your accounting rate of return, your return is higher than the cost of borrowing, right? When the return is higher than the cost of borrowing, you could say that, oh, this project will maximize shareholders' wealth. Now, under the modern techniques, there are two approaches where we have the net present value and the internal rate of return. Right. Now, let me talk about the internal rate of before the NPV. Now, the internal rate of return, it is still the usual method of calculating the return that the investors will get. Now, remember that internal rate of return is try and error approach. the positive NPV, negative NPV, the lower rate, and the higher rate, right? Then, if you calculate the internal rate of return, and if the internal rate of return is greater than the cost of borrowing, let's say the internal rate of return is 2%, and the cost of borrowing this fund is 10%. That is, it means that, or it indicates that the project is not viable. The project will not maximize the shareholders' worth. Why? Because their internal rate of return for investors is lower than the cost of capital, which is the cost of borrowing, right? Then I equally explain further that sometimes the question will say determine the modified internal rate of return. It is when you are not satisfied with the internal rate of return before you will now do what? You calculate the modified internal rate of what? The modified internal rate of return, right? Now, in calculating the modified internal rate of return, there's formula for calculating what? The modified internal rate of return, which you can see that in your material. The PV divided by PV times 1 plus R, 1 minus 1, right? So we'll get to this part, right? So it is still the same what? The same decision. Now, I want to explain that there is what we call growing annuity. Now, growing annuity formula is used whereby, okay, let me quickly explain the NPV before the growing annuity. Now, NPV, if you want to determine your NPV under the modern technique, make use of a relevant cash flow that are relevant for the project, right? Now, if you want to determine your NPV, your inflow, your net cash inflow minus your outflow. Your outflow is your cost, your variable cost, your labor that you incur in the process of executing that project that are relevant to the project. Now, when you deduct it, you have your net cash flow. When you have your net cash flow, of course, they need to pay tax. Now, when you remove the tax, you have your net cash flow after tax. If there is tax savings on capital allowance, if they dispose the assets, if there is sales proceed, if there is working capital, you take into consideration of that. Then you have your present value. You have your balance. We'll look at that. After that, you discount it, right? The question is, what are you going to discount your cash flow? Now, what you will use to discount your cash flow will take us to another part, either the real or the nominal. We'll get to that point. But before I move to the real and nominal, in discounting your cash flow, I need to explain this every time. Maybe before we finish our investment appraisal, I will still be coming back to this part of relevant costing again and again and again and again. Now, one of the relevant costs is opportunity cost, right? Alternative forgone. Now, instead of you to embark on this project, you can even save money, right? You can even save money. It means that you may actually forgone the project and save what? And save money, right? We'll see a case scenario like that. So opportunity costs are always relevant. So is in the question that you now see if the opportunity cost will be an inflow or an outflow. Now, financial cash flows are not relevant costs because your loan dividend and preference dividend are being used to determine the cost of capital. The cost of capital. Now we have with the working capital. We'll get to the computation of working capital. But working capital is what you use to run the business at the beginning of the project, not even at the beginning, at year 0 when the project they've not started the project. Of course, you say this is the money you will take to run it. It is at year 0, unless if it is stated otherwise in the question, right? Then at the end, you use 50,000. Then at the end, you have to recoup back your investment. So that is the reason why you will see working capital. Sometimes it becomes an inflow, outflow, at the beginning. At the end of the project, it becomes what? An inflow, right? And it is always what? Relevant. Now, we'll get to the computation as we move. Now, material class. Material, when material needed for a project, is available in the what? In the company and has alternative uses, the relevant cost is the replacement cost. Now, when you have a material in the store, you have a material and it has alternative use. It has what? It has alternative use. The relevant cost is the what? Is the replacement cost of that particular what? Of that particular material. But when material is available and has no other alternative use, the relevant cost will be the what? The realizable, the amount you will sell that particular asset, the material, or the sellable value, or the net sellable value, realizable value. Net realizable value means that if the material sales proceed is 20 naira and you now incur 1 naira, or you incur is 200, you incur 100 naira, the net is what we call net realizable. The relevant cost will be the net what? Realizable, right? But where material is not available at all, right? When material is not available at all, the relevant cost is the current purchase cost. What is current purchase cost? The value, the current market value, that same value of that material, in the what? In the market, it becomes the what? The relevant cost, right? Please take note of these three items. When it is available and has alternative use, the relevant cost will be the replacement cost. When it is not available, when material is available but has no use at all, you have to sell it if it has a realizable value or the sellable value, right? But you need it. It's not available, but you need this material. What will be the relevant cost? The relevant cost will be the what? The current purchase cost. Now, in the case of labor, now the normal labor, those is a committed cost, is a sunk cost. The normal labor that you see, that it is actually fixed, that at the end of the month, whether you continue with this project or you don't continue with this project, they will pay you a certain amount of money at the end of the on a month-on-month basis. It is committed, it is sunk cost, so it is not relevant. But what is relevant here is a casual labor, right? Casual labor that you just employ them to come and do one or two things in this particular project, right? So the relevant cost will be the amount you pay as wages to the casual workers. Therefore, it is relevant. Then if there's any overtime, it will only be relevant when it is paid on the specific project concern. Of course, even full-time workers can actually work overtime sometimes. And that overtime, if that overtime relates to the project, of course, the relevant cost, you have to recognize it as a relevant cost. Now, variable overhead is always relevant unless stated otherwise. Class, variable overhead is always relevant unless stated otherwise in the question. Why? The fixed cost is always fixed, right? Unless the examiner gives us the portion that is incremental. So when you see an incremental fixed cost, right, specific or relevant, right, an incremental fixed cost is actually a relevant cost. Don't forget that anything that has to do with apportionment, right, it is not relevant, right? So these are the relevant costs we'll be looking at. In our first lecture, we did not finish that particular question. Class, we'll be looking at a question. We'll solve question on a project that have a relevant cost. From there, we'll move to a project that have the tax savings, as well as the conversion of money cost of capital to real cost of capital. From there, we look at a question that have sensitivity analysis. Then we look at a combined question before we move to capital rationing. Now, my point here is, when you want to determine the NPV, you use a relevant cash inflow and cash outflow that are relevant for the what? For the project class. Now, the question is, when you have a positive NPV, it means that the project will maximize the shareholders' worth. It means that the project will do what? Will maximize the shareholders' worth. So therefore, they should go ahead and do what? And embark on that particular what? Project. Now, in discounting your project class, in discounting your project, okay, in discounting project, a minute, please. Now, in discounting projects, we'll get to what you will use to discount your what? Project, the worst case scenario and the best case scenario that you could see when discounting what? Project. But before that, let's quickly do a recap on inflation. As we all know that inflation is something, a persistent rise in the what? In the general price of goods and services. Now, as a project finance manager or as a financial expert, you should be able to say that when they want to embark on a project, you should be able to predict that, okay, what will be the inflation. Of course, when you are projecting for the future, of course, when you are calculating your NPV, it is what is expected to occur, expected cash flow, expected cash inflow. When you are doing that, you need to consider what we call inflation, right? The future what? Inflation, based on the what? Some macroeconomic what? Indicators, right? Now, there is what we call general inflation. Okay, sorry, please. So there's what we call general inflation and specific inflation, right? Now, when it is general inflation, that is when you see that the existence of single inflation rate in a question is clear indication of general inflation, right? When you see that in the question, they will tell you that the sales variable cost, fixed cost increased by the same percentage, probably 3%. And you should know that it is not that I can will ask you what is general inflation, but you should know that okay, this is general inflation, right? Why specific inflation that you may see in the question is when you have different rates, right? The existence of more than one inflation rate in a question is an indicator of what specific inflation. Maybe in the question, your sales will increase by 5% in year one. Variable cost will increase by 10%. This will increase by 6%. That is what we call specific. It is specific for each of the variables, right? And that is why it is called specific what? Inflation. Now, class, another problematic under the NPV is the relevant cash flow, the money cash flow and the real cash flow. Please, I want you all to pay attention. We've explained this in our previous class, so I just need to do a quick recap on what we did in our previous lecture. Now, the cash flow, there's what we call money cash flow. Now, money cash flow means that cash flow has been inflated. It is inclusive of inflation, right? It is what is inclusive of what? Inflation, class. Why real cash flow means that their cash flow without what? Without the effect of inflation. A practical illustration is someone who receives a salary of 20,000 naira. That salary that you receive as 20,000 naira, it is a real cash flow, not money cash flow. But when you factor in inflation of 21.6% as of today, then you will now know that, oh, it is not 120 in money term. It is maybe around 15,000 to 14,000 that you receive as what? As salary. Can you see it? So money cash flow we have when the cash flow has been inflated. Now, when you inflate your sales by 5%, for instance, you inflate your sales by 5% and you have a figure. That figure you have is what we call money cash flow, because you've inflated the cash flow, right? But in a situation whereby they give you information in real time, there is a general rule here. Immediately after the debate, there's a general rule that we need to also know as well. Now, having explained this, we have what we call money cost of capital and real cost of capital. Class, use money cost of capital or use money cash flow to discount money cost of capital. Use money for money, use real for real. Use money cash flow to discount money cost of capital, meaning that in question, because examiner want to test you, they will tell you that the sales will increase by 5%. Okay, this variable cost will increase by 6%. That your cash flow that you get is money. Now, instead of them to give you money cost of capital, they will not give you real cost of capital. They will not tell you that, okay, there is a real cost of capital of 10%, meaning that you need to convert that real cost of capital to money cost of capital, right? Now, in determination of your money cost of capital, it is calculated as equals MCC equals to 1 plus RCC, close bracket, 1 plus I, which is the inflation rate given to you, the general inflation rate given to you in the question, minus 1, we give you the money cost of capital. So when you convert it, when you convert that view to money cost of capital, you cannot use it to do what? To discount the what? The project, right? Then, if it is real, it will be stated in the question. There's a general rule I put under after this real cost of capital, right? There's a general rule we'll get there, right? Now, if you have a real cost of capital, let's say the cash flow given to you is in real term. Another question that someone may ask is, how do we know that this particular cash flow is real term? You will know. It will be stated that this cash flow is in real term, right? It is in the current term. When you just hear that word, current term, real term, constant price, it means that this is a real cash flow. You use real cash flow to discount the real cost of capital, right? But the examiner will still test you. We want to test your knowledge on the conversion. They may give you the money cost of capital. Therefore, you need to convert to real cost of capital. However, if you want to convert to real cost of capital, it is calculated as RCC equals to 1 plus MCC divided by 1 plus I, the general inflation rate, which is I, inflation rate, minus 1. We give you what? Real cost of what? Real cost of capital. Now, let's quickly look at the general rule before we continue our question, right? Now, rules in solving inflation question: use money cost of capital to discount money cash flows, and real cost of capital to discount real cash flow. This is very, very important, please. Now, identify the nature of cash flow. That is, let the cash flow indicated the cost of what? The cost of capital to be used. Of course, the cash flow should be what? You need to check the cash flow. It's the cash flow that will determine which one of these you are to use, whether it is real or nominal. Now, real cash flow are those exposed class. Please take note. In year zero prices, constant prices level, the current terms or the real terms. They will give you in the question that, okay, the cash flow are in what? Are in real term. The cash flow are what? Are in real term. Now, lastly, when the examiner, right? Wow, this is 28 minutes too. Okay, wow. So where the examiner is silent as regards the cash flow, right? When the examiner is silent about the cash flow, it is assumed to be what? A money in terms. Class, when the examiner is now silent that you don't even know whether it is money or it is real, it is assumed to be what? To be money term, and so on like that. Please, you have the material, you can read on that, right? Now, there is taxation here. Don't forget that in capital allowance is granted in lieu of what? In lieu of depreciation, right? Now, there is balancing allowance as well as balancing charge. Of course, we all know this, that when your tax written down value is lower, when your tax written down value is lower than the sales proceed, right? It's lower than the what? Than the, or your sales proceeds is lower than your what? Your tax written down value. You could say that this is balancing allowance, and therefore it is a loss on disposal. The relevant tax authority will grant you a relief on that what? On that allowance. You claim it, you claim allowance on it. And we have what we call balancing charge. You dispose an asset now. That is capital gains, right? This will take us to what? Capital gains, right? No, when you dispose an asset, you have a balancing charge where the sales proceed is higher than the tax written down value. You have what we call balancing charge. Of course, it is an inflow. It will be treated. Of course, you have to what? Charge tax on it, right? Then, in the last year of disposal, let's say the lifespan of that asset is 5 years, right? Let's say the lifespan of that asset is 5 years. Is to last for 5 years, normal. And in the last year, they now dispose the asset. The law says that last year that you dispose that asset, you will not claim capital, you will not claim any allowance on it unless if it is balancing allowance. You can't calculate capital allowance again on that particular asset that you want to dispose or that you've disposed in the year of what? In the year of disposal, right? In taxation, they say, oh, leave 10 naira. Is that not so? Leave 10 naira. Leave 10 naira. Now it is about 2% you have to leave, right? Based on the new tax reform. So the sensitivity analysis. Now, what is sensitivity analysis? Shows changes in the variables. Changes. Sensitivity analysis means that you as a project finance manager, look at yourself as a project finance manager. Okay, you are expecting this. This is what you are. This is the expected cash flow. This is expected cash inflow. Okay, now what will be the changes? Changes means that at what point will you make a sales to the extent that if that sales increase more than that percentage, right, it will make the what? The NPV to become what? To become zero. Now, I give an illustration in our last class that your selling price. Now, when you want to calculate sensitivity analysis of selling price, right, which is your sales, it is net NPV divided by the present value of the what? Of your revenue times 100. Then you now calculate it, you get 5%. Now, that 5% that you calculate, it indicates that you should not allow your selling price to fall more than 5%. If not, your NPV will become what? Zero or negative. That is what it means, right? Now, the same thing applicable to contribution. You calculate your contribution, sensitivity analysis of contribution, you have 5% or you have 50%. What is the implication? The implication is that you should not allow it to fall more than what? 30%. If you reduce more than 30%, what will happen to your NPV? Becomes what? Negative or zero. But let's quickly move to cost. If you have a fixed cost or a variable cost to be 5%, for instance, or to be 20%, for instance, and you calculate your sensitivity analysis to be 50%, right? Now, it means that you should not allow that your variable cost to increase more than 50%. If not, your NPV will become what? Negative. That is the implication. Imagine you're a project finance manager and you've calculated your sensitivity analysis to be 50%, and someone now bring an additional quotation for this project that, oh, okay, you have to add this, we need to buy this and this. You have to show the person that, okay, if you adjust anything here, this project will not be viable. We will not get money. We will not get profit from this project, right? Everybody will go back and adjust and adjust and adjust. That is the importance of what? Sensitivity analysis. Of course, in financial modeling, when you are doing a modeling, you have to do what we call margin of safety as well, right? At the point at which we know that, okay, investors should go into the market to buy a particular shares. At the same time, these points, they should not go because of there's kind of a noise in the market, right? So it is as important as anything. Sensitivity is what? Analysis. Now, let's quickly capital rationing. We'll cover capital rationing when we are done with the part of the relevant cost as well as all other inputs. Class, are we still together? Chai, it seems I'm the only one in this class.
We are together, sir.
Yeah, we are with
Yeah,
you. We
together.
are enjoying the class.
On this journey.
Okay. Okay. Thank you. Today, I hope you come to this class with your food flask and everything. Because it's going to be a long class anyway.
No problem.
Right. Okay, that's fine. Okay, now we're solving a question in our last class, which is on this particular question, right? So we need to complete this question. What I just did is just to do a brief recap on what we did in our previous class. That is 30 minutes, 34 minutes. Wow. Okay, now in our previous class, we're solving this question, and we stopped at where we have a redundancy, right? Where we have a redundancy fee. But this presentation is actually poor. My apologies for that, right? This is not, I think that day I'm not so fine, right? So currently limited is not supposed to be like this. It's supposed to be determination.
Limited.
Okay. Okay, Kenny, thank you. Kenny Limited. Determination of net present value. So this is supposed to be the presentation, right? So you have to present your work this way, please. It is very important you present your work like this, please. Now, we stopped at, for those who are just joining us, you can watch the video, the first one, right? So I just need to continue from where we stopped, right? So we're able to, okay, so we're able to talk about the redundancy field. This will be the savings, while this will be the cost at the end of the what? At the end of the project, right? So we need to put the labor cost. The labor cost per MTD, right, is 250, right? 250 per unit, right? 250 per unit. So let me quickly do a table where I will use that 250 to multiply my unit what? Demand, so that we can move on, please. 250. Okay, I think we've started it already, self. Okay, labor. Okay. Labor costs. Labor costs. Okay. So labor costs. Labor costs. Oh. Labor cost. Okay. So don't forget that in this question, they gave us from year 2. They purposely do it like that. They give us from what? Year 2. So labor cost, which is 450 naira per MTD, is itself. You multiply it by the unit what? Unit demand, right? Which we did. We've done that already. From 2 to labor cost. Okay. Labor cost. Okay. So year 2, we have 500. 500. Year 3, 17,500. 17,500. So what next?
31.
Yeah, 31. Thank you. 250. Okay. And what do we have next?
5,000.
Okay, we have 5,000. What is this one for? sorry, a minute. Sorry, a minute. Okay. Okay, 16 million for the costs of the machine. Right. Okay. Mm, okay. Where did we have this figure here? Okay, I'm coming. I think it's from this side.
Size material cost for year 5.
Okay, material cost for year 5, right? Okay, okay. Okay. Okay, thank you. Okay, material cost for year 5. Okay, thank you. So, this is year 2, year 3, year 4, right? So, do we have for year 5? Is it up to year 5? Okay, 500, right? 500. Is it 500 or 5,000?
5,000.
Okay. So we can move, right? So do we have any other costs or any other relevant costs? Let's quickly check.
We have administrative,
Before,
variable.
before administrative, we have the fixed production overhead relating specifically to the production of the MTD are expected to be 6,500 in the first year. That is year 2, right? To be 6,500 in the first year. And variable production overhead are expected to be 150 per unit produced and unit produced and sold, right? So meaning that in our first year, right, we will have in the first year, that is year 2, we have 6,000 was 6,500, right? Now remember that when we are reading this question, they didn't give us inflation. They didn't tell us that, oh, the sales will increase by this. So now this cash flow now that we are calculating, that we want to get now, the cash flow, all our cash flow now will be what, class? All our cash flow will be what? We assume to be what?
In money terms.
Money terms.
Money terms.
Thank you. It is as simple as that. So it is assumed to be in what? In money term, because we're not given any information about the real, that this will increase by 5%. Now this will increase by what? By 6%, right? So we have 16,000 in the first year. Fixed production of relating to the production are expected to be what? In the first year of production. Is that also? And variable production are expected to be produced and what? To be produced and sold. So now let's quickly do a quick calculation on. So now please multiply your in the first year. What is the first year? Still 6,500 per unit. The first year is what?
Year 2.
Year 2. At the year 2, 6,500 times 2,000. What do you have? Okay, let me copy the table. Let me quickly copy this.
We have 13 million.
13
That
million.
would be 30,000 naira.
Okay, 13 million. Okay, that's fine. Okay, that's fine. So they say they incur it for the project. So is that not so? So will I be multiplying that that figure? Now you see, now some people will say I should multiply it all through. Okay, let's check. Fixed fixed production cost per unit. So what is the fixed production cost per unit, class?
6,500.
6,500.
From year 2, Abi, there's no need for me to do this. Yeah, let's just
Yes.
okay, from year 2. Now, class, they say they incur it specifically for the product. Is that not so? So it means that your fixed production overhead does not change according to your demand. And it will start from year 2. It does not change according to your, unless if it is stated otherwise. Class, they said it is incurred specifically for the project. You cannot be using 6,500 times, maybe you do for year 2. You now still do 6,500 times 70, 6,500 times 1,125, 6,500 times 20,000. That would be very wrong because your fixed production overhead does not change according to the what, to the demand or the unit produced. They've given us hint that is it only change, just you will just have it in the first year of production. It is incurred specifically, meaning that you will incur the same thing, the same fixed cost from year 2 to year 5. So therefore, we have 13 million, right? Fixed cost. So what do we have? 13 million, right?
Yes, 30 million.
Okay, I'm coming. So 6,500. Year 2. Is this year 2? Okay. Year 2.
Yes, year 2.
Year 2. What do we have? 13 million.
Yes.
Yes.
So year 2, you have the same 13 million. Please, these are the notes you need to add to this place. Please, in your notes, you can, all these notes, it is very important. The labor, how we arrive at our labor, how we arrive at our material, please attach it. When you see a question like this that has to do with relevant cost, so test your knowledge on the relevant cost in capital investment, you need to show your notes, right? You need to do what? You need to show your notes. Thank you. So this part you can have, still have 13. Right, we still have here 13. Right? Are we good? Are we still together, please?
Yes, sir.
Okay, that's fine. That's fine. Kende.
All right. Thank you, sir. Well done, sir. I want to ask a question concerning that fixed cost. Please,
Okay.
can you scroll to that part of that in that question
Yes,
of
sir.
that fixed?
Okay, do you have it in your note? Do you have it? Do you have the material?
He said, I expected to be in the first year, and there was no part of the question that say it continues up to other years. So I suppose, is it a one-time course or it's going to be spread across the period of the project?
Yes, since you are embarking on that project, and that project is from 2, 3, 4, 5. Is that not so? And they say it is specifically for the project. So definitely relating specifically to the production, And you have to produce in year 2. You produce in year 3. You produce in year 4. Don't forget, they want to produce MTD. That is the project. The project is production of MTD, right, Kenny? So it means that as they are producing, they will incur the fixed production, right? But it is actually fixed. Do you get?
Yes, sir.
Okay.
Thank you, sir.
Okay, thank you. Nina.
Oh, sir, can you just ask my question? Thank you, sir.
Yeah, you're welcome. Any other? Okay, Dari, quickly, please. We have a long way to go, please.
Mr. Brian,
Yeah.
good afternoon.
Good morning.
Good morning.
Maybe in Canada you dey.
No, I'm in Nigeria. I never Japan.
Quick.
Stay on this discourse now. I need a small clarification. I understood that is a specific fixed cost of capital, fixed cost, and it should be relevant, and that's why we recognize them. But this, look at it now. They now say fixed production overhead relating to specifically to the production of MTD. I expect to be 6,500 per unit. This per unit here now, I don't know. Maybe GBT is there by mistake, or because if it's the exact
No,
situation, someone to
no,
apply. So please,
you will want to apply it all through, yeah, Abi?
because when I
Abi?
say per unit,
You will want to apply it all through, Abi?
I will now start. If I exam now, I will have been saying
Oh,
6,005 times 2,000 units in year one, 6,005
Dari,
times.
Dari, fixed cost does not vary
Change.
I know.
according
Unit of
to unit demand. Class, if they are producing that product, MTD, they will be in theory. They say in the first year, they will be in year 2, meaning that as far as they are producing that product, that fixed cost that they have in year 2 we continue like that till they say, oh, they will not produce MTD again because it is specifically for the production. Do you understand? So it's part of what you need to take notes. Do you understand?
I understand.
Okay. Thank you. So then we have the variable. Now, when you talk about variable now, fine. You cannot talk about variable because the variable stated here is that variable will be what? Variable production overhead will be what, class? Will now varies. So these are the part of the notes you need to do what? You need to add to your what? When you are preparing an investment project like this, for the users or for investors, let me say for investors to do what? To actually understand your point, you have to note it. You have to take note of all these points. So a quick one. Let me quickly copy so that variable, variable, right? Variable production 150, right? 150 naira per MTD, right? 150 variable. So 150 variable, I'll use VC per unit too. It's variable cost per unit. 150, right? Kenny?
Yes.
Okay. 150. 150. 150. Right. So we need to multiply this. We multiply this. Please, I need the total variable cost overhead. This will be in naira.
300.
Thank you. Okay. Okay, 300. Okay. What do you have here?
10,500.
10,500. What do we have here?
80,750.
18,750. What do we have here?
3,000.
8,000. So we quickly, okay, 3,000, right? So we can copy this as my variable production, variable production overhead. So this will be 300. be 10,500. 10,750. And then 3,000. Right. Okay. So after this, what do we have again? From our question, we have variable production. What do we have? We have administrative, right?
Yeah.
So administrative costs are expected to be 17
million.
Yeah, 17 million per annum, of which 5.5 million is allocated. Anything that has to do with allocation or apportionment is not a relevant cost. From the head office, and the remainder relates directly to the production of MTD. Right? So meaning that we have to remove the 17,000, right? 17 minus 5.5. 17 million minus 5.5.
11,500.
Thank you. 11,500 is administrative costs. Administrative cost does not vary, fixed, right? And they have to produce MTD. It is specifically, it is directly to the production. So please, so we have, what is the difference? Administrative, please take note of that in your notes. Administrative costs. So administrative costs. 13 million, right?
11,500.
Okay, 11,500, sorry. 11,500. So we have 11,500. 11,500. Right? 11,500. So the next one is 11,500. Right? So what next do we have? We have working capital. We have working capital, right?
Yes.
Okay.
Recovered.
Thank you. Working capital recovered. Okay, working capital, 10 million will be required at the beginning of the second year. Class will be at the beginning of the what? Second year. You can see that this working capital, they can give you in any form. This is the first case scenario. This is the what? The first case scenario. At the beginning of the what? Of the second year. Once the production and sales of MTD have commenced. This will be released when the production and sales of MTD cease, which means at the end of the project, at the end of the production of MTD, they have to release the working capital, and it will be at the beginning of year 2, working capital, right? Which is 10 million. So at the end, so we can assume that all our cash flow are in money term. So definitely what we're given will be a money term, right? So we can have net cash flow. Class, okay, I will do another presentation after this because we have another question like that. And class, one thing I want you all to understand that, you see, NPV is one of the questions that is, you have to pay attention to the details very well. If not, you will miss it. Now, the sales, if there is tax now, if there is tax, it's because of the way I arrange it that night, actually. What I would have done is to just consider my sales first, my costs, variable cost, fees cost, incremental, and all that first. Then I will now have the machine, I will have the redundancy, I will have some other costs that are actually incurred. I will have that. Then I will now do my sales proceed, or tax savings, if there is any, right, we'll look at all those steps in our next question, right? So please, someone should just give me a figure year 0, $18 million. Where did we see 18 million to be in year 1? Let's check. Hello, class. Who put this 18 million here?
It's
Meant to be in year 0.
year
Okay.
0, 18 million.
Okay.
I thought as much.
Let's check again. Where is it? Where is the 18 million? Where is the 18 million? Oh, 18 million. Away.
Up factory building.
Okay, factory building. Okay. The first installment is payable immediately. Okay, that's fine. And take note of this one as well. You can see at the end of the first year, which is year 1. You see, at the end of the first year, which is year 1. So please quickly give me figure. We never finish this question since away. Question. This will be
Year 0, 20,000.
is what? Year 0 is what? That is
minus 16,000.
thank you, 16,000. So what do we have here?
28,000.
Please, I have a
negative.
question. Why are we having
I'm
working capital amount in the first year and in the last year?
They said at the beginning of year 2. Who is the person that asked this question? Is it Esther? We're in our class. Did you start this class with us first?
Yes, I'm always in your class.
Okay. So at the working capital is what you use to run business. Esther, you use 50,000 to run business at the beginning of January. At the end of January, you recoup back your investment. That is what it means. You put it in, then at the end of the project, you take it back.
Okay, so it's not a savings or an income to us now.
So yes, you remove it at the beginning. Is what you will use to run the business. Your current, your payable, your trade payable, your inventory, So after that, at the end of the project, it becomes an inflow to you. Don't worry, you still understand it more when we
Okay.
solve more.
Thank you, sir.
So what do we have? Yeah, you're welcome. We have is what?
28,000.
We have
28, negative 28, minus 28,000.
28.
Yeah.
Okay. 28,000. Okay. So what do we have here? Please quickly.
830. Negative.
What do we have? Negative.
31.
Negative 31, 830.
31.
830.
830. Okay. What do we have here?
$52,500.
52.
500.
500. Positive, right?
Yeah.
So what do we have here?
38,000.
28,000.
38.
38. So what do we have here? So DCF is how many percent given to us in this question? How many percent?
9%.
9%. 9%. 9%. So the examiner, this question tests your knowledge on relevant cash flow that will be used for a particular what project.
13,000.
So
Final year.
okay, 13,000 positive, right?
Yes.
Yes, positive.
13,000. So the DCF for year one, this will be 1. This will be what? 0. What?
0.92.
Okay, no, 3 decimal. 3 decimal.
Okay.
What do we have again?
0.917.
0 point what?
917. 0.842.
842. Next.
0.772.
0.772. Please, someone should just give us the value, the figure for the present value so that we'll move. What do we have here?
0.708.
0.708. What do we have here?
0.650.
0.650.
MPV 7430.15.
Thank you. That is the MPV, Abi.
Yes.
Okay. Let's just, for the purpose of this class, let's just have our present value. Present value, right? So just give me figures. So the first one is the
16.
present value, 16. So what do we have here?
25,676.
25,676. What do we have here?
26,800.8.
26,801.
801.
Next.
40,530.
40,530. What do you have here? What do we have here?
26,904.
26,904. Okay. So what do we have here?
8,450.
8,450.
8,450. Oh, excuse me. So what is the present value? Oh, excuse me.
$7,407.
So that year 2, I mean, that year 3 is negative. Oh. You are putting 52,500. I think. Is it not negative?
It's not negative.
Please, how did you get the present value? What exactly are you doing? I understand the rest. Sorry, I'm just joining. I just want to get how you got the value of the present value. Please, thank you.
Net cash flow multiplied by the discount factor, the rate.
Okay, so you mean for the year 1, 20, it's for year 2, that's 28,000
times 0.917.
So what is the MPV class?
7,407.
Okay, so the MPV 7,407 is a million, right?
7,000, not 17.
Okay, 7,407.
I beg check.
So that is a million now.
407.
So are we still together, please?
Yes, sir.
Okay, so what is the decision Your recommendation is that the
So
project,
that year 3, let's look at the calculation again as that lady suggested.
you can do that.
No,
Please, you
she's
can.
right. He's right.
Everything is in circle.
He's right. Mm.
So you can do that at your own time, please, so that we can move, please. Right? So you can check. Now I'm not with calculator actually, so the figure that you gave me, I just use it like that, please. Now, if we have this to be the MPV, right? So what is the decision? Your recommendation, or you can write down, or recommendation or the decision that the project, the project's MTD is viable, right? Is viable, and it will do what? It will maximize the shareholder, right? So, and that is what you will just note, right? You can even indicate the figure, right? From the above analysis, projects, if it is, you want to present it in a professional way, okay, in the above analysis, the project MTD gives a positive MPV. Therefore, the project will maximize the shareholders' wealth. Simple, right? And the question says you should justify your cash flow. That is why I said your note is very important. That's how the note that you identify this as relevant cash flow, this one is not relevant. You have to state it. You have to state it in the what? In the what? In the note. Class, am I communicating, please? Who is against me in this class? Do we have anyone that is against me? Okay, we are good. Okay, now let's quickly use they say we could use I mean one stone to kill two birds, right? Now, what if the question says that determine the project's duration? Class, determine the project's duration. Let's say determination of project duration. Right. Project duration means that if you as an investor, you invest in this particular project, this is the time that will take you to recoup back your own money that you will invest in the what? In the project. Class. Right? The time.
I think firstly, the first thing is that we need to determine our yield to maturity first. Our YT.
For where? For where?
Because from the formula of duration.
Are we doing bond?
I got to you just need some money.
Hey, God, I beg.
Okay.
Guy Ibrahim.
You are actually, let's say, you're correct to some extent, because that is what we do under bond valuation. Is that not so? But now, this is a project, not bond. Class.
All right.
What you use to discount it is your DCF. You already have your present value already. Is that not so? So that is what you will use to discount. So therefore, how do we structure this? We have to structure it out, right? We have year zero. Year zero will give us zero now. Okay, let me do it this way. Yeah. Determination of project duration. Please take note. So I will assume that I've covered this part. Let me just do it once like this. Project duration. Please, it is not part of the requirement. Please take note. So we have year 0, year 1, year 2, year 3, year 4, and year 5. Should I do it like this? Okay. Please don't forget the way we normally present our workings now, right? So me, I will not write. I will just items. I'll just say items. Cash flow. So after items, what do we have, class? We have the DCF, right?
Yes, sir.
Cash flows before this
Cash
year.
Yes,
flows.
Cash flow
yes,
before
that's
this.
good. Yes, I want to
What is
skip that.
DCF?
Yes, I want to skip that part because we already have the present value already. Is that also?
It's
So
okay.
you can just do PV.
Okay.
Oh, then weight, right? Weight, right?
Yes. Wait.
Then PV
PV times
times weight.
weight.
Okay, thank you. So the first one is 0, right? Leave that one. So we have 16. So this will be 0. And this will be 0, right? So this is cash flow. Let's say cash flow. CF, cash flow. Don't write CF in exam, oh. Please. Cash flow, new. So what do we have here? We have negative 25, 6, 7, 6. So we have 1. So we can have 25, 6, 7, 6. Cash flow, just put cash flow or 2. 26.
But that 16,000 not in negative.
Which one? 16,000. Put it in negative. 0 times 0. Is it not 0? Okay, that's true.
Okay.
That's true. Yeah, correct. Thank you. 26,801. So please multiply.
53,602.
Okay. 53,
602.
602. 40, 530. So if we are actually right too, but we are not in bond valuation, okay?
121,590.
121.
590.
590. Okay, that's fine. Year 4. What do we have? Oh, it's not positive. It's positive.
It's negative. Positive. Sorry.
Okay.
That 121 is positive too.
Okay, that's fine. Thank you. Okay, thank you. This is 26.
26.
So I'm using one bed to key to.
Yeah.
We have to the talk on.
Times 4.
So what do we have here?
107, 616.
616.
6, yeah.
So this is 8,450. So what do we have here? This is 5.
Yes. 42250.
42250. Okay. Okay.
We have a bigger boy.
Ogaraji.
Yes, sir.
Please mute your mic. Thank you. We don't hear our voice. Thank you.
Sorry, sir.
Yeah, no, that's fine. No, that's fine. So, so what is the total? Yeah, your total of PV?
PV times weight 192,178.
192,178. What do we have here? PV?
7407.
What do you have?
7407.
740. 74 what? Sorry.
07.
7407.
7407. Like this?
Yes, sir.
Yes.
Okay. So duration. is equals to 192,178 divided by 740, Abi? 7407. What do we have? What is the duration of the project, class? The question did not say we should do duration of a project, so I just let me quickly bring in the duration of a project, should in case you see it, so that you will not say IB did not teach you duration of a project, how to determine duration of a project. So it is still the same.
25.9.
25.9.
25 years.
Ah,
and
no,
1926.
25 years.
no, that is too much actually. But
25.9.
25 points. So I'm just showing you. So it will not be like this, right? It will not be like this, right? It will not be like this because the question did not say we should do what is it called? Duration. Is that not so? The project duration. You should not forget what we normally do, what we normally use to determine the duration, what we come out from the project, right? And yes, what we actually come out from the project. Okay, remove 16,000, 16 million. What do you have? If you remove 16 million from this part, what do you have?
We have eight years.
You have 8 years, Abi?
Yes, approximately.
Okay, if you remove the 16, what is it called? Duration of the project. Okay. This one will not be part of it. It should not be part of it. It's the cash flow. Year 1, year 2, year 3. There is no year 0. Thank you. So let's do it this way. No year 0. So this is 8. When you add this together, what do you have? 25 plus this minus this plus this plus this plus this. What do you have?
23,407.
23,407. 407. So what do you have? 23,407.
8.21.
8.21. If project is what is it called? The project is
5 years.
5 years. It will not take you 8. Now, technically, you can see this question. I purposely say I want to introduce the project duration. We'll move now, right? But guess what? Don't forget, when you want to determine duration, is what you will get from the what? From the project. Is that not so? It is what you will get from the project. Now, if you look at the information given to us, you will see that if you want to look at it, the project will start from which year? The project will start from which year, class?
From year 2.
From year 2.
Year 2.
Definitely. At year 0 or year 1, you should not be expecting anything from your investment. It means that you will be expecting something from year what? From year 2. Now, I didn't mean the question did not start from year 2. We would have started from year 1, year 2, year 3, year 4, year 5. Class, how do we determine the duration of a bond? Now, let's change it again. What do you have here? Remove that figure. What do you have? Let's start from year 2.
So we now have approximately 4 years.
Thank you. Can you see? Okay, now give me this. What do you have here? What do you have here? What do you have here?
In the present value or the weight?
Yes, present value times weight. What do you have?
Present value, we have total 49,118.22.
49.
No.
What?
For the present value.
Okay, continue. Okay, 49 what?
49,118.22.
8. Class, when the desirable is not available, the available becomes the desirable. Do you know why I change it? Because, okay, quickly, just give me this figure first. Don't worry, you understand though. Don't worry, I'm coming. Just give me this figure.
854.
217854.
217854. Thank you. 217854. Yes, I just think you're supposed to have something closer.
Yeah, that PV is not correct.
Yeah, now what is the PV? Quickly, please.
It's supposed to be 49083.
Please, others should confirm. 49083. 083. So what do we have? What is the duration? What is the duration?
4 years. 1.4.
Okay, 4.4. It will take them 4 years. 4 years and months. 4 months to recoup back their investment. Class, do you know the reason why I change it? Because, please, you can mute your mic. Because the production and the demand. Now, if you invest in a project, of course, because of the nature of the question, it's supposed to start from year 1, year 2. They started from year 2. No problem. All right? There's no problem about that. Now, if you invest in a project, you should not expect cash flow from that day. No, now it will not be from year 0, it will be from year 1. But the question starts from year 2. Definitely, as they are making a sales, you will have your own share from year 2, year 3, year 4, and year 5. That is the reason why I change it. So from year 2 to year 5. However, if you have year 1, year 2, year 3, year 4, year 5, yes, you can use it like that. Year 1, please don't put year 0. You will not get any cash flow in year 0. You will still you've incurred what is it called? Expenses, right? In year 0. You will start from year 1, year 2. Remember, duration. Consider the relevant cash flow, the present value, the present cash flow. Class, who is against me? Are we together? Are we move? Can we move?
Yes, we can move.
Okay, that's fine. So if this is established, thank God. Okay, determination of project duration. Please take notes, right? Okay, so I have a question here. Question 2. Question 2, please. Okay. Okay. Now, calculate the NPV of the proposed investment. Class, another way you can see capital investment appraiser is when you want to discount a project. Apart from money and will, if you want to discount the project, you will now use project-specific cost of capital. Now, class, it is possible that I want to embark on a project. And this project that I want to embark on, I have to identify a similar company that are doing that same thing. Probably I want to diversify. So meaning that I will not use ordinary cost of capital, whether it is money or it is real. I have to include the risk for me to get the project specific cost of capital. You may see a question like, I think I have a question like that as well. Right. So this question now says, calculate the NPV of the proposed investment. NPV. So this question will now test your knowledge on the tax and the conversion of real cost of capital or the nominal cost of capital. So please, I want you all to pay attention, please. Now, please, who will read? 2. Someone should read though. Please don't
Okay,
forget.
can I read?
Yes. Oh, thank you. Wait, just wait. Sorry. Please always understand. Please understand the requirement of the question. Please, the way we will solve when we get to decision tree. In fact, you will fall in love with decision tree because you will see it. Now, don't just because you see simulation, don't just rush because it is capital rationing. Don't just rush to it. Understand the requirement, right? Research shows that if students understand the requirement, right, it is assumed that you've solved 60% of the question. That is the reason why first we've read the requirement that says that determine or calculate the proposed MPV. Okay, you can go ahead, please.
Temidayo Limited. Okay, requirement first. Let me go to requirement. Go to requirement, sir.
No, just read. Just read. Go on.
Okay, Temidayo Limited is considering a new investment which could start immediately and last 4 years. And last 4 years. The company has gathered the following information. Assets. Asset cost 8 million. Funding. Okay.
Okay. The assets that we use for this project cost 8 million. Okay, please go ahead.
Funding, a loan note with annual interest of 6% will be sourced to finance the assets. The
Okay,
loan
now,
will be repaid at the end of 4 years.
Okay, thank you. Now, is this loan, is it a relevant cost? Class, is it relevant?
Yes.
Yes, sir. To me,
the loan is relevant. Hey.
It has to do with the
No,
asset
sir.
now.
But no. Remember that anything that has to do with finance, this is not adjusted present value. This is MPV that makes use of cash flow. Anything that has to do with finance, it
Please, I'm not hearing anything. Is the class still going on?
Yes, I'm not hearing too. I think a network logged him out.
Okay, thank you.
Please, I'm not with my phone. Let somebody shout him up on WhatsApp group.
Hello, class. I just called in now. He said he will be with us in the next 5 minutes. The network just logging out.
Okay, thank you for the information. Thank you.
Hello, sorry, I just joined back. Is the class over?
Just hang
Nope.
in there. We are coming back. The guy, network is disturbing him. He's coming back. Just hang in.
All right, thank you.
Hello. Thank you, Taib. I'm back.
Welcome back.
Thank you, thank you. Okay, where are we? So, please, loan note. It is not a cash flow, please. It is not. It is part of, if you check the note under the financing, finance working capital, or the finance, under the finance, I said preference shares, dividend, loan notes, all these things are not relevant because you've used them in the determination of the cost of capital. So when you are using it again, just like you are repeating what you've done before, right? So which is not what allowed. Thank you. Victoria, please can you continue? Oh,
I'm here, sorry.
okay.
So annual sales are expected to be 30,000 units in year 1 and 2, and will then fall by 5,000 units per year in both year 3 and 4.
Now, thank you. Now, the annual sales are expected to be 30 units in year 1 and 2, meaning that is what they will be in year 1 and year 2. Will then fall by 5,000 units. Then in year 3 and year 4, it will now reduce by 5,000 naira. Okay, please go ahead.
The selling price in the first year term is expected to be 220 naira per unit, and this is then expected to inflate by 3% per annum.
Now, as a result of this, when you have the expected sales of year 1 and year 2 to be the same, then the selling price in the first year terms is expected to be okay. Is the class going on? Hey, sorry. I'm not supposed to leave the class now.
Yeah.
Yeah. Okay, I'm coming. So, okay. Now, the selling price in the first year term is expected to be 220 per unit in the first year term, and this then expected to inflate by 3% per annum. After that, you will have to increase it by what? 3%. So when you increase it by 3%, so it means that it has become which cash flow? When you increase a cash flow by 3% with inflation, that is, it is what? It has become which cash flow?
Money terms.
Money. So definitely you need to use the money cost of capital to do what? To discount the project. The variable costs are expected to be 35 naira per unit in current terms. Can you see? It means you can see that in current terms, that is in real term. And the incremental fixed costs in the first year are expected to be 15 naira per unit in current terms. That is in real term. Now, both of these costs are expected to inflate. No, not inflate it too, right? Inflate at what? At 5%. Is that also? So when you inflate it at 5%, it becomes what? A money term. Now, the asset is expected to have a residual value, right, of 2 million in the what? In year 4. In year 4 prices. In year 4 prices. Just leave it is in real term. In year 4 what? Prices. It could have been because maybe they've actually factored in inflation for them to say, okay, in year 4 prices to arrive at what? 2 million. Now, The project will require working capital investment equal to 10% of the expected sales revenue, meaning that when you do your sales, your revenue, for you to get the working capital, you have to do what? The 10% of the what? Of the expected what? Revenue. And don't forget, working capital will always may start at year 0. In the first question, it was stated that the working capital will begin, they will be working at the beginning of year 2. That is why we put it in what? In year 2. You can see. Now, in this now, working capital have to start with from what? From year 0. The investment must be in place at the what? At the start of each year. At the start of what? Each. Corporate income tax. Corporate income tax is 30% per annum, and 30% per annum, and is paid 1 year in arrears, meaning that tax is being paid in what? In arrears, meaning that year 1 will be paid in year 2, year 2 will be paid in year 3, year 3 will be paid in year 4, year 4 will be paid in what? In year 5. Now, reducing balance, 25% reducing balance written down allowance are available on the cost, meaning that instead of depreciation, they have to charge what we call capital allowance. Of course, that is where we will have our tax savings, right? Okay. Now, general inflation, excuse me. General inflation is 4%, and the real cost of capital is 7.7%. You can see they're giving us the general inflation, meaning that they've given you money. They say you should inflate all those cash flow, which it has become money. Then they now give you real cost of capital. So meaning that you need to convert that real to money cost of capital. They've given you the general inflation that you will use to convert the real cost of capital to what? To money cost of capital that you will use to do what? To discount the project. The company has already spent 1.5 on initial research, out of which 1 million has just been paid, and the balance is scheduled for payment at the beginning of the year. So, class, is this a relevant cost?
The 1
Is
million
this
is
relevant?
not a relevant cost.
Thank you. It is a what? It is a sunk cost. It is a what? A sunk cost. Right? So it is, as a professional, it's part of the notes. You need to like, okay, this is it, right? This is how it works. So therefore, the research is not what? Is not a relevant cost. It's a sunk what? Cost. Okay, suggested solution. What is the name of the company? Suggested solution. Okay, suggested solution. What is the name of the company? Temidayo. Right? Temidayo. Temidayo. Maybe it's like this. So determination of proposed net present value on investments. So how many years the project is to last for how many years, class? 4 years. So let's start. 4 years. 4 years, please. You need to pay attention. This question, as small as it is now, right? You can, right? That is why they say it is 15 marks. I think this question is adopted from ACC. I think it's one of the ACC AFM question, right? Now, you see that and lasts for 4 years. And when you look at it, if it lasts for 4 years and the tax is being paid in arrears, meaning that year 1 will be paid in year 2, year 2 will be paid in year 3, year 3 will be paid in year 4, year 4 will be paid in year 5. So definitely we need to have year 1 to year 5 years. Year 0, year 1, year 2, year 3, year 4, year 5. So please, our naira sign, or should we keep in naira, right, in thousands, right, in thousands, in thousands, in thousands. Okay, please, this is very important, please. Okay. Away. Okay. So, okay. This is very important. Oh, year 4, year 5. Okay. Now, for start with my workings, I can, let me just do the workings down. I can have here to be the workings. Workings. Right. Okay. Now let's start from the sales. The annual sales class. We should not forget that the annual sales are expected to be 30,000 units in year 1 and year 2, and we therefore by 5,000 units per year in both year 3 and year what and year 4. Let me do the workings here. Okay, working should be here. Sorry, let me just do it here. So that's workings. So I can have here year 1. So sales. I want to determine the sales. The first year is 30,000 units. So what is the selling price? What is the selling price? And the selling price in the first year. No, first, before we even determine the selling price. Okay, before we determine the selling price stuff, let's finish with the unit. Right? They said we will have this in the year 2. Is this now? Year 2 will be 30,000 units, and it will fall from year 3 by 5,000. So it means you have to reduce it by what? 5,000. If you reduce this by 5,000, you have what? 25,000. Right? So let me write it before someone will. Let me write it out here. Let's say you have 30 minus 5 given to us, you have 25. Now, so the next one is 4 years. It will fall by 5% for year 3 and year what? And year, so this will fall by 5,000 units. So this will give us 20,000 units. Class, are we following? Are we still together, please?
Yes, sir.
Okay. Now what's next is what? The selling price. Now, the selling price in the first year terms is expected to be 20 to 20, right? And this is what? this is then expected to inflated by 3% per year. Plus, they've already given us the basis already in the current terms. In first year terms, is expected to be 220. Don't forget that the question says the selling price in the first year terms is expected to be in the first year term. And what they give us is 30,000 units in year 1 and year 2, right? And this is then expected to inflated by what? We're not inflated by what? 3 point what? By 3%. Is that also? So now let's multiply by excuse me. Let's multiply by 220. So we have 220 naira per unit, right? 220 in the first year. What do you have? In the first year, what do you have? Let's say we leave it in thousands. Okay. So what do you have here?
6,600.
6,600. Now, if you have this to be 6,600, and they said it will now fall, right? It will now, the selling price will now, this is now expected to inflate it, sorry. It is now inflated by what? By 3%. Now, so therefore, we can have this 220 times, if you increase to 3%, 3% is 1.3. Is that also 1.03?
Yes. Yes.
Is that also, class? 3%?
Yes.
Okay. So we can have times 1.03 plus. If we have times 0.03, are we going to raise to power 2? Are we going to say raise to power 2?
I think it's going to be raised to power 1 since it is the first year of increment.
Yeah, the following one will be raised to power 2.
Thank you. You see, it is what it is. Thank you. Because that will be the first year. Is that not so? So you don't, this particular one, this particular one, the next one will be raised to power 2. Is that not so, class? Hello?
Yes, year 2 will be raised to power 1 because it's the first year of increment, and year 3 will be raised to
Increment. Thank you. Because it is the first year of increment. This year, this one will be in year 1. Raised to power of year 1. The next one will be the first year that you increase that thing, that you increase that variable. Raise it to power of 1. Then after the next one is year 2. Raise it to power of 2. See, forget about the year. Understand the language. Right? Thank you so much, Kende. Makes sense. Right? Makes sense. Now, so what do we have here? So let me say raise to power of 1. Please, if you did not understand, just let me know. Please, I beg. So what do we have here?
Hello, sir.
Is it the total figure for revenue?
I don't. Okay.
Yes.
Let them
total
get the figure because.
Okay.
6,798.
6,798. Now, before I continue, let's quickly go back to the question again. Class, they said in the first term, this will be 220 in the first year. And after that first year, there will be second year, third year, and then this then expected to be inflated. That year, the second year is year 1 because that is the year you will start increasing it. It is raised to power of 1. Class, are we still together? Who is against me in this class? Please, who is against me in this class? Hello? It seems I'm the only one.
We are fine.
Okay, so
Okay,
you
okay.
see that anytime we see like terms is expected to be, so definitely is raised to power something.
No. Okay, I'm coming.
Don't.
I get you.
Because I was
Fumi.
thinking they'll make that 6,600 times 1.03. That's
Oh,
what I was thinking. Mm.
oh,
Me
okay.
too.
Okay. Mukuna wait now. Mukuna wait. Interesting. It makes sense. It makes sense. Now let me start from Fumi. I'm coming. I'm coming. You see, that your thoughts. That your thoughts. Okay, we'll use it. We'll use another method. Boy, I'm coming. Now, Fumi, the selling price is in first year is expected to be this. That is in the first year. No increment. That is 22 times 30. And they said, and this then expected to inflate by, then after that year one, after that the first year, it will now be inflated by 3%. You increase that figure by 3% because the second year is the year you start inflating the what? The variable. It will be raised to power of 1. The formula is 1 plus inflation rate. 1 plus inflation rate raised to power of the numbers, right? You're not seeing my working notes. You see it. My working notes, okay. Don't worry, you see it. So raised to power of what? Raised to power of 1. Do you get? Now, in another case scenario, right? In another case, right? You can also do something, right? Now, you have 66,000. You have 66,000 because we're not given the same variable. Don't forget, from this year, the unit will change. That is why I don't want to use that approach, right? That is why I don't want to use what? I don't want to use that approach. You can also use 6,600 times 1.03. If you do
You will not
6,000,
get the same. You will not get the same thing,
you will not
sir.
get the same thing. So it will not work like that. Do you understand? It will not actually work that way. But then, for me, are we still together?
Yes, we are together.
Okay. That's fine. Now, in this now, we can have 220 times 1.03 raised to power of 2, right? This will be raised to power of 2. So what do we have here?
5834.
5834. 0.94. I mean, that is 5, right?
95, yes.
Okay. So this will be
95.
okay, 95. Okay, that's fine. So this will be raised to power of 3. This will be raised to power of 3. What do we have here?
4,808.
4,808. Please mute your mic. Oh, is that okay? 4,808. This is the sales. Okay, I'm coming. Let me show you something. Okay. Yeah, I'm coming. Let me check. I think I wrote something on inflation. Ahead. This is it. Can you see? I know I wrote something out. Any item stated in year 1 prices no inflation in year 1 unless stated otherwise in the question. And that is why it was stated in the question that this is what will be in year 1. That is, inflation becomes applicable from year 2. So if you are starting it in that year 2, it has to be raised to the power of 1, because that is when you will start what? Inflating that particular variable. So let's quickly go back. Where is it? Okay, so our sales sales, we have the first year sales 6,000 what? 6,600, 6,798, 5,835, 4,808. Okay, this is new because the tax is being paid in arrears. So we need to check for the variable costs, the relevant cash outflow. Now, okay, that is our sales. Please, we should not forget that this is a sunk cost. This is not a relevant cost, please. It is not a relevant cost because it has been used to determine the cost of capital. So we are done with this parts of sales. Now we move to variable costs. The variable costs are expected to be 35 naira per unit in the current terms, and the incremental fixed costs in the first year are expected to be just like this. Now you can see it again. The incremental fixed cost. Incremental fixed cost is a relevant cost. Incremental fixed cost in the first year are expected to be 15 naira per unit in what? In current terms. Right? Now, both these costs, both of these costs are expected to inflate at what? At 5% per annum. In the first year, the variable costs are expected to be in the current terms, and the incremental fixed costs in the first year are expected to be what? Both of them are expected to be in their current term in the first year. Then both of these costs are expected to inflate at what? At 5% per annum, meaning that after the first year, right, the second year you have to start what? You have to start inflating it, right? Class, the variable costs are expected to be 35 naira per unit in the current terms, and the incremental fixed costs in the first year are expected to be what? Class? Are expected to be 15 naira per unit in current terms. Both of these costs are expected to inflate at what? 5%. Now let's go with the variable cost first. And don't forget, they did not say both variable costs and incremental fixed costs are expected they have the first are expected to be this. So now let's pick it from the variable cost first. The variable costs are expected to be 35 naira per unit in current terms, and both of these costs are expected to inflate at 5% per annum. So variable costs, variable costs. Class, don't forget that our unit is 30, 25, and 20 units, because that is what is being stated in the question, please. This should be okay. So variable costs, variable costs. So what is the cost per unit? What is the variable cost per unit, class? What is the variable cost per unit?
35.
Let's deal with this first. Right.
35.
Okay. 35 naira per unit. And they did not state that in the first year for the variable cost. They didn't state anything that This 35 now, right? 35.
Yes.
Okay. So what do we have?
105.
105. Both are to increase times how many percent?
5%.
1.05, right?
Yes.
Raised to power 1. Raised to power 1. For me, are you still with us?
Yes, I'm here.
Do you understand it?
1,000.
No, wait. Do you understand it?
So this one now, they said in current terms.
Yes. That is
The
this. Okay. Go ahead.
the inflation, is it starting in that first year? Because according to what you showed earlier, you said inflation does not happen in the first year. So why are we doing times?
Unless stated otherwise. Wait, I'm coming. I understand. It's coming. I said unless stated otherwise in the question.
Okay.
Okay. I'm coming. Okay, please. For me, interpret this part of variable cost first. Like, just interpret it the way you understand. The way you understand it.
No.
Kinda. Okay. Okay, for me, wait. Kinda. Quickly.
Yes, I think what Fumbin is trying to ask is that, you know, in the one that we did for revenue, I think the question was very explicit that it's going to start from the annual inflation will be 3%. In this case, they are saying that the variable costs are expected to be 35 naira per unit in current terms, and it's going to be increasing by 5% per annum. I think what we're trying to say is that shouldn't that be and in the solution that you are trying to do now, in the first year you write raised to power 1, and if you are following, I think she's trying to say that shouldn't it be raised to power 0, which will give us 1 because it is starting in year 2 actually.
No, it is not. No, it is not. That is according to the question. It is not starting at year 2. The question says that the variable costs are expected to be this.
Excuse me, sir. Does that mean that the variable costs are expected to be 35 naira per unit in current term? The current term is referring to year 0. Is that what you mean, sir?
No. The current term is
Pre-term.
that is in real term.
In real term, there is no inflation.
The current term here. Don't forget. We should not forget that we have money cash flow and real cash flow. In current term means that we have not inflated it. Oh, in current terms, we have not inflated it. So this is what we have. If you multiply 15 naira per unit times the unit, we give you the real cash flow. Right? Now, the question now still go further and say, both of these, let's forget about the incremental, because the other part is talking about the incremental fixed cost. And the next part says that both of these costs are expected to inflate at 5% per annum.
Please, can I ask?
Okay.
The inflating at 5% per annum, is that where it's stated from the first year? That per annum?
Yes.
Is that the understanding of from the first year?
From the first year.
Okay.
So sorry, sir. That is the peak inflation for variable costs and increment.
Yes. Now let's okay, I understand. Now, I think the question says that the variable costs are expected to be 235 naira per unit in year 1 and year 2. That is another. We have to or the variable costs are expected to be 35 naira in first year. Class, in first year. In first year means that first year, it will be in that term. the subsequent year will now be raised to power of 1, just like the way we did in the first one. But the question did not say like that. The question asked, okay, let's do it this way. Okay, the variable costs are expected to be this. In current term means that is the real cash flow. Both of these costs are expected to inflate. Now you will now increase it by what? By 5% per year. Now, the second part of the incremental fixed cost in the first year are expected, meaning that that first year will remain the same. Class, meaning that that first year will remain the same. You will not raise it to power of 1. After year 1, you cannot say, oh, raise to power of what? Raise to power of 2. Right? Just like the way we did in the first one.
Okay, I think I get it now.
Okay. Though when we do the incremental fixed cost, you will still understand. All right, thank you. Temitayo.
Thank you, sir. My own submission on that was I was thinking that 35 naira per unit is on current terms, that is current year, which can be taken as year 0. Then we start the increment in year 1.
Okay, that is another interpretation. That's in current terms, does not mean that it is as year 0. That is another thing. That is why I'm coming. Let me show you something. It can be in current term, it can be in what? In year 0. Oh, inflation. Let's quickly go back to that inflation. Okay, where is it? Inflation. Now, this is it. Real cash flow are those exposed in year 0 price, constant price level, current terms, now or real terms. Do you understand? Either in current terms or in year 0 prices. So we can say, okay, it is what? It's a real cash flow, right? So okay, your explanation, it makes sense that, okay, the current terms will be at year 0. Is that not so? And the current term itself is what? Is a real cash flow. So after that year 0, you will now have, because both of these costs are expected to inflate per annum. So year 1 will be raised to power 1. Year 2 will be what is it called? Raised to power of what? Raised to power of 2. Class, are we still together?
Yes, sir.
Okay. So 335 1.05. This is 35. Okay, 1.05, right? 5%. 5%, and this is 4. Okay, so what do we have? The first one, what do we have?
1,104.
102.5.
Okay. 1,000.
102.5.
1,103.
Next, what do we have?
1,158.
1,158.
1,013.
1,000 what?
013.
1,000. So what do we have here?
850.
851 actually.
851. Okay. So incremental fixed cost. So in a nutshell, we can say this current terms, this figure in current terms is in year 0, and it will start the inflation from year what? From year what? From year 1, right? So it means that it's in year 0, but it will start to inflate it from what? From year what? From year 1. So incremental fixed cost. What is the incremental fixed cost again? Okay. Incremental fixed cost. Okay, let's check. Okay, let's check. So okay, where is it? Okay, incremental fixed cost.
15 naira per unit.
Okay. Now we can see that we have, where is it? Okay, and the incremental fixed cost in the first year are expected to be this. Is that also incremental fixed costs are expected to be this in current terms? We can see that they still put it in current terms. Is that also meaning
Yes.
that would be at year 0, and they say both will start to increase. Is that also both of these costs are expected to inflate at 5% per. So after that, year 1 you have to inflate it raised to the power of 1. Year 2 you have to inflate it. Year 3 you have to inflate it. Class, am I communicating, please?
Yes, sir.
Me, sister.
Oh, you say?
Yeah, this part it said, and the incremental fees cost in the first year.
I expected
to be 15 naira per unit in current terms. You know, the
Yes.
variable cost, they didn't mention anything about first year. They just said in current terms. So this one that we have first year now and current terms, is it still going to be first year that the inflation will be starting?
Yes. Okay. Okay, for me. Excuse me. Now, and the incremental fixed cost. If you look at this first year and check the one of selling price, you can see that they are not the same. They didn't tell you that the selling price is at the current terms. Is that also? Was it stated? It wasn't. You understand? So if they say something is at the current terms, it means that it has year 0. And they now say that both of these costs are expected to inflate at 5% per annum, meaning that after year 0, you have to inflate it from year 1, year 2, year 3, year 4.
Okay.
Do you understand? So you can see that the first case scenario is the selling price in the first year term is expected to be this. And this then expected to inflate by 3% per annum. Is that not so? So meaning that after the first year, what do we have? You start inflating it from the what? From the second, from the third, from the fourth, from the fifth, like that. Do you understand? It wasn't stated that it is at the current terms. When you see current terms, it means that that particular variable is at year 0. So immediately after that, what is it called? Term, you will now start to inflate it. It will be raised to power 1, raised to power 2, raised to power 3. Temitayo.
Sir? Hello, sir.
I'm with you.
Yeah, the confusing part in this second one of incremental fees cost is that he's saying first year and he's also adding current year.
Yes.
So we are now confused. Yes, sir.
Okay, that is why I said, since you have the current terms to be this, okay, since you have the current terms, 15%, 15 naira per unit in current terms, since you have this to be in the current terms, it will be at the year 0. Now, if you look at what we did first, if you look at what we did under selling price, Is that not so? What we did under what? Under sales. Now, the first year, the selling price in the first year terms is expected to be this. Class, in the first year, is expected to be this, meaning that it will be like that. They did not say, oh, this will be in the current term. I think they say this selling price in the first year is in the current term. All right? It means that, oh, that will be at year 0. Immediately after that current term is year 1. So you can say, okay, we will start the raise to power from year 1, year 2, year 3, year 4. But the question did not say that. The question says that the selling price in the first year term is expected to be this, meaning that after that first year, the first year is expected to be that figure that you have. Then after that, you have raised to power 1, you have raised to power 2, you have raised to power 3. Do we get it?
Yes, sir. That one is understandable. Yes, sir. It's understandable.
It's clear now. It's clear. Thank you.
Thank you. So anytime you now see a term is in current term, you know that, okay, that would be year 0. Okay, definitely after that year 0, you have year 1. So you start to inflate it from that year 1, year 2, year 3. Right? No, we'll see when we solve like 2 to 3 questions, you see it. Right? I think this is the second question, right? Okay, maybe I'll look at maybe another question like that. Sure. Okay, so we have, what do we have here? Is this the same figure? Okay, what do we have here? Hello?
472.5.
Okay, wait, I'm coming. What is it's 450, right? 450.
No, is it 450? I think it's 15 now.
Okay, let's check now.
15.
It's 15.
Okay, it's 15. Okay. Sorry. Oh, 15.
I hope there is no one bet today.
Okay. I'm there. Under investment appraiser. No. Leave one there. It's remain 90 days.
Thank God.
What do we have here?
473.
473. So we'll end this class maybe at we'll go for break. Yeah, 47. We'll go for break. Maybe we can go for maybe 10 minutes break. Then so that we'll come back, right? So we'll end this class maybe by 4:30 to 5, please. So what do we have here?
450.
450. Please, others should confirm the figure. 450.
375.
375.
No. Sorry.
The second one is 496.
Sorry.
Okay. Next, what do we have?
435.
435. What do you have?
Then 365.
What do you have?
365.
Yeah, fixed cost does not change.
So we have yes, we have to look at the
okay, let's go back.
The first yes.
Let's go back and check what happened. Okay, and the incremental fixed costs in the first year are expected to be this. Both of these costs are expected to be inflated. Okay, that is a very good one. Thank you so much for the observation. So in the first year, thank you. So we're supposed to have okay. Incremental fixed costs, okay. Sorry, I'm coming. And the incremental fixed cost in the first year, I expected to be this. Okay, what do we have in the first one? Sorry. Fixed cost. Okay. Okay, that's fine. So does not varies, right?
Yes.
Class, are we together? Thank you. So so we should have
I'll be 30
That's variable
multiplied
cost. That's
oh
variable cost.
That variable cost.
we
Yes, we are going to use 30,000 unit multiplied by
Throughout.
15 naira.
30, right?
Throughout.
30. Thank you. I didn't even look at that part. Thank you so much. This question is, I think it's one of the past questions. 15 marks like that. So what do we have? You can see the question is not much. If you look at it that this question, I should do them now within 10 minutes. I don't finish or more. If you didn't analyze this question very well, you may not even get up to 10 marks self, because the major work is from this part of when it is current terms. I think the question is trying to test your knowledge on whether you understand when it is in real term, in real cash flow. Please go back to that note where I state that you will have, when they say something is in current, it means that it has year zero. So immediately after year zero, you start to inflate it. However, when you have the selling price in the first year term is this, meaning that will be that is what we have in the first, and this is then expected to inflate. After that year one, we now start inflating it, right? After the year one, you start to start inflating it. That is what
Hello,
it
sir.
means.
Hello, sir.
Hello,
My
sir.
own
That's
my own
unique.
suggestion regarding the fees cost is that they said it is incremental. They didn't just state that fixed cost. So it has to vary with the level of the output.
Yes.
So it is
Uh-huh.
incremental.
Yes,
Incremental.
they say it's incremental. They did not put it as a fixed cost.
My dear.
Okay. Which any other suggestion?
What we are going to do is a 30,000 units for the first year multiplied by 15. It will give us 450,000. So that 450,000 is going to be what we are going to use throughout the year. Then we are now going to start increasing it by the 5%.
It's still the same thing. I'm coming. I'm moving
right,
away.
okay.
There is incremental fees cost, right? Incremental what? Fees cost. Now, the first question we should ask ourselves, if you have a fixed cost and they say this fixed cost is for the project, will it vary according to what you are producing?
That's what I was trying to ask. If the cost is based on the units or just on the price cost?
It is based on the units per unit. So as you are producing, will your fixed cost will not be varies? No, it won't. Kende? No, it's good we have discussion.
Okay.
And that is okay. Go ahead.
I want to add, since we say that concerning this incremental fixed cost, as we are pegging it to 30,000. Now, if the product, the unit produced now exceeds 30,000, are we still going to limit it to that 30,000?
Yes.
That's why I'm opinion that it's referring with the level of output.
No. It will still be that 30,000 units. Because in the first year, because fixed cost is fixed, but because you want to produce that product, they now tell you that they mention it that in the first year. In the first year, right? In the first year means that That will be the cost all through, because just like the way we did in the first one, that will be the cost all through. Then if you have that cost all through, you have to inflate it. It does not vary with what you are producing.
It's the price.
Right? It's the price. You can, it does not, thank you. It does not vary. It does not vary at all. Temidayo.
Yeah. Yes, sir. That takes us to the initial discussion about current rate and what's it called? Current terms. And in current terms, we are not giving the quantity, but we are giving year one. So I said that thing will start from year one, then year two we increase it. Because in current time, we're not giving quantity in current time.
I think we've moved from that part now. The terms of current parts or no current parts. Right?
It is the that we are talking now. In current times, there's no unit. But in year one, we have units for it.
Okay. Okay. And the incremental fixed cost in the first year are expected to be this. In the what? In the current what? In the current term. Is that not so? In the what? In the current term. In the first year. That is why that word in the first year is there, because they know that it is an incremental fixed cost. Incremental fixed cost does not change according to what you are producing. Of course, you will use it in the production. You will use it, but in the what? In the current term means that it will be at year zero. Immediately after the current terms, you have year one. But my point here is that incremental fixed cost does not vary according to what you produce, and that is the reason why the question says in the what? In the first year. Are we good? Are we good?
Yeah, we are good.
Yes, sir.
Okay, so what do you have here? What do you have here? Just like what we did here.
30,000.
I'm coming. What we did here under, where is it? Is it this question? Is this question now? Is that not so? Is this question that we did fixed cost? Yes. So we just multiply and inflate it. So coming. So what do we have here? This is correct, right? What do you have here? This is not correct.
21.
521.
521. Next. What do you have here?
547.
547. Class, I just want us to please just understand this. I just want us to understand this thing, right? So once you understand it, you can see the question, right? Once you understand it, you can be able to, like, at least you solve a similar question like that. Always pay attention to this part of the incremental. Of course, if I see it, because you call it incremental fixed cost, you're like, oh, incremental fixed cost. It will vary now. Started.
Sorry, sir. But this question, because it happens that I've solved it before, because it's a similar started question. But in that solution,
that is in that solution. So if that is in that solution.
Okay.
Do you understand? I don't solve question the way it is. in the solution, in the pathfinder. I don't do that. Go and check. Just go and ask people. Go and ask those people who actually
It
pass.
is actually not iPhone. It is CMOS.
Okay, go ahead. Just go ahead. Sorry. Just go ahead. Go ahead.
It is a semi-strategic question, and the way you structure the question is the same way they structure the question. So just that figure changes. And I
Okay.
think they use the 30, 30, 30, 25, 20 as regard the incremental fixed cost.
That is what they use. And
yes, sir.
and what was their answer? They have the same days. Did they have 473? No, it's changed. Did they have 473 or 496? 521? Taib.
That's what I'm saying. I said in the solution, some figure changes, like where you are using, like where you are the figure changes, where you are using 15 naira, you use 0 point something dollar. So
Okay. Yes. I understand. Thank you so much. Okay, quickly before we continue, Dari, is it Dari now? Dari Sheyi, right? Quick. Yes, sir.
Yes.
Yes, sir. I can hear you.
I was just trying to. I know for this question, the way it's structured, if we maintain 30, it might be right, because incremental, generally speaking, accounting is a additional cost incurred because of certain decision you took. So normally, incremental here means that this 15,000 naira is not part of original fixed cost. They are based on the unit produced. Since the 30 did not increase from that level, rather than it's reducing. If for this question, maybe we might adopt it. But if you have a question that whereby at level of 30 you are increasing, you are earning 15 per unit, and now you are now at level of 40,000 units. Still maintaining the incremental fiscal per month, it might not reflect the true cost of that project. That's my own opinion.
Okay. In accounting.
Yes.
Thank you. I love that you said in accounting. Is that also? Okay, that's fine. Now, the incremental fixed cost, and you want to embark on a project. Let's go practical. You want to embark on a project now, and you have to incur a cost. Let's say rent now. Rent is a fixed cost, unless stated otherwise. Rent is a fixed cost. You pay in the first year of the project is 30,000. Now, because of there will be as a project finance officer, because you are thinking ahead that okay, inflation could be 19.8% or 16% at the end of December. Okay, I need to increase this by 16 point something percent. However, as a project finance officer, you should not base your fixed cost based on what you are producing. It is because you need it. You need it as a service in the production, in the what for the project. That is why you have to consider it as part of your cash outflow. This fixed incremental fixed cost now, that is why they say incremental. They purposely use that incremental so that you will now feel that, oh, incremental, definitely your fixed cost will now be varies according to the units. And that is the most common error. You now say, oh, because it is incremental. Whereas the question I've stated that in the first year, they should have 15 naira per unit. Please, am I communicating, please?
Yes, sir.
Hello. Okay. Please, are we good to go?
We are good to go, but sir, there's something I really
Sponsor.
want to know. Yes, sir. In the sense that, sometimes the lecturers will say that they don't use the Pathfinder, the answer or the steps that the Pathfinder have given or solution. But we've forgotten that it's still that Pathfinder that they give to the markers that they use to mark our exams. Is it not, sir?
Okay.
No, capital
I
no.
don't
That's
know.
not it.
I don't know. Me, I don't know. I don't know.
Sorry, that's how they always put disclaimer. They put disclaimer on the Pathfinder.
Okay. Oh. Okay, please, can we continue? Because why? Okay, thank you. Why, as we move, you will see what like you will have a reason to say that you have to understand that topic as we move on, because maybe during our intensive we'll look at some questions, even in class now we'll look at some questions there. Then you will now compare the way we solve it in class and the way it is in the Pathfinder. I'm not saying it's not correct. I'm not saying, but I'm saying that sometimes if you want to use that to study, it may look confusing as well, because they will not explain to you that this is how they do it. They will just tell you that this is it. Before you know, they don't calculate answer and they move on. Right. So please, let's move on. So
okay, sir.
So after the incremental fixed cost, Madam Victoria, are you still with us?
Yes, I am.
Okay. So after the incremental fixed cost, we have the assets. The assets is what? The asset is expected to have a residual value, is the scrap value of 12 million in year 4 prices. Class, based on the question I've solved under capital budget or investment appraisal, you see this residual value. They may still give you this residual value in real term. They will still give you in real term because they want to test your knowledge if you will affect, if you will inflate, you will actually affect that inflation. But now it's given to you that, okay, in year 4 prices, it means that they've considered a whole lot of inflation on it to be at the year 4 prices, which is what? 2 million. And the project will require working capital investment equals to 10% of the expected what? Expected revenue. So let's quickly working capital. Working capital. Working capital. How many percent of, okay, let's do it this way. Working capital. Yes, 0. Toib. It's a lower question. He said he's Sima. Even me, I don't even know that he's from Sima. Wait, I hear you. So 1, 2, 3, 4. Right? It's for what? 4 years. And the last year is the other part, right? So I'm coming. Let's say, what is the sales? Let's do it one after the other. We said working capital is how many percent? Working capital.
It's 10% of sales of revenue.
Okay. 10% of revenue. So I like this question. I liked it. It makes sense. Yes. so that we can disagree, we agree, we disagree, so that when you see it, you will at least see similar questions. So 10% of the revenue, right? So we quickly do the 10% of each of the revenue. So give me a figure, please. 10% of year one, 10% of 6,000. This will be
16.
okay. Just hold on. Sorry. So what do we have here? Year one.
0. Year 1, 6 is 0.
660. Year two.
680.
680. Year three.
584.
584. Year four.
481.
481. Right? So you now do your changes in working capital. Changes in working capital. All right. Changes in working capital. So, class, this is how it is, right? At year 0, you will have CC0. Class, it is like this. So now you can see that from year 0 to year 1, what do you have? From year 0 to year 1, what do you have? You have CC0. Is that not so? Is that not so? CC0, meaning that the working capital has increased. Is that not so? So you can have CC0. Then in year 1, if you look at what we have in year 1, you have CC0 in year 1. You have 680 in year 2. What is the increase? Increase means what is the difference? You can see that the working capital increased from 660 to 680. What is the increase, the difference, class?
20,000.
20. It
20.
increased, but it increased to 20,000. So the next one, you can see from year 2 to year 3, you have 680 in year 2. You have 584 in year 3. Right? What do we have? Is the working capital? Is there any increase in the working capital or reduction?
Reduction.
So what is the reduction? What do we have?
96.
96. Thank you. Thank you. Meaning that in year 2, you will have 96 as inflow. We'll get there, sir. So the next one, from 584 to 481. You can see that there is still a reduction in the what? In the working capital. Meaning that as a project finance officer, is it finance officer? Okay, let me just use project finance officer. As you look at it, that okay, the working capital is decreasing. What does that mean? It means that there will be an increase in the cash flow. Is that not so? Will be an increase in the what? In the cash flow, meaning that we are not spending more. We are not spending. At least we have those, we are not spending. It's not that we are not spending, but it is not, it's actually reducing, not the way it's were in the what? In the year 1 and in year 1. Right? So what is the difference? What do we have?
103.
103. Now, you still now look, you have 481, right? 481 minus 0, you have what? 481.
Yeah.
Or when you get to the year 4, you look at it that, okay, you listen, please, you have 481 here. The next one is year 5, which is 0. You will look at it that, okay, the working capital did not even increase at all because it still remained 481. Because In the 5th year, you have 0, no working capital there, right? So you have 481. You have what? 481, right? So someone should add 481 plus 103 plus 96 minus 20. What do you have?
Minus 2660.
Thank you. Thank you. That is what I want to confirm. Class, it is not a magical. When you incur a working capital at year 0 of a project, right? At the end of the year, you have to recoup back your investment. And that is the reason why 96 becomes an inflow. 93 becomes an inflow. 94 becomes an inflow. In year 1, you have spent 20. When you minus the 20, you have your 660 that you use to what? As a working capital to what? To finance the project. Class, am I communicating, please?
Yes, sir.
You don't understand. Away. Unmute your mic. Away. Okay, that's fine. So if you look at this is the working capital, 10% of this of the revenue, right? If you have 10%, okay, that's fine. That's fine. So if you have 10% of the revenue, please pay attention. So what you have here is 0. What you have here, just put this on to be 0. And just okay, you have here 0 and you have here 1. Meaning that the working capital has increased from this place to this. That is increase. You have this. Then come to this side and say, okay, you have 660. From this side to this side, you have increase. It becomes an outflow. From this to this, right? It decrease. When we get to free cash flow, we see this working capital will be doing it when we get to free cash flow as well. But just still understand it here, right? Excuse me. Now, this minus this, if you minus 584 minus 481, you have 103. That is why I say changes in working capital. Then the last one, you have 481 minus 0. 0 means that is the last year. You can say minus 0, meaning that the working capital did not increase, did not what increase, but it decreased. 0. 481 is higher now. Then you have your 481. Class, are we good to go? Are we good? Okay. Thank you. Thank you. So I think we are done with the adjustment. We need to move. So the first, please, you just give me figure. You can screenshot the variable cost and the incremental fixed cost, as well as the working capital, please, so that you can give me figure. We'll move. Okay. Hi. What about the capital allowance? Okay, that's fine. Should I do capital allowance? I think. Dari.
Mr. Ibrahim.
Yes, sir.
Can you hear me?
I'm with you.
Can you hear me? Yeah, please.
Yeah.
You know, in this question now, we treated this working capital this way because they say that this amount of investment must be available at the beginning of each year. As
your network. Okay. I don't hear anything. Me, I don't hear anything. Your network. Thanks. I don't hear anything. Thanks for the network.
You heard me now. You heard me now.
No.
What I'm saying is that in this question now,
yes, I can hear you.
In this question, they said the working capital will be to be available at the beginning of each year, and this is the treatment we have. Assuming they say it to be available at the end of each year, will the treatment be different?
Yes, 10%.
Yes.
So if
I understood the 10%
at the
application.
end of each year, meaning
And
that
will the treatment be different?
Yes, meaning that yes. I think one of the question if they say at the end of each year, meaning that at the end of year one, meaning that what you have in year one, what you have at the end of year one will becomes at the beginning of year two. Right? I don't expect such question. What you should have asked is that sometimes the working capital, they may tell you that the working capital will increase by, for every 1 naira increase, that is the language, for every 1 naira increase in the revenue. I think is one of the past questions. For every 1 naira increase in the revenue, you have to increase the working capital for like that. Do you understand, Mr. Dari?
Yes, I'm with you.
Mr. Dari, we'll get there.
Okay.
Do you understand? Or should I give you the answer is just
I understand you. I understand you.
Okay, that's fine. Okay, thank you. So capital allowance. Please, should we go for a break? Determination of capital allowance, or we should continue? Capital allowance.
Let's finish it.
Let's finish the capital allowance.
Okay, that's fine. So capital allowance.
Let's go for a break.
Capital allowance will not take us much now. Let's just finish it.
Let's go for break and come.
Okay, I'm coming. Let me finish this part, please. Okay, capital allowance. So you have here will be your items. You have your capital allowance, or you have your tax savings. We can have tax savings. How many percent? What is the tax rate? What is the tax rate?
30%.
Tax rate is
30%.
Okay. So to be tax savings on capital allowance, they will have tax due. Tax due. Okay. So what is the cost of the asset? Asset
80
cost.
million.
Costs. Let me just use it this way. Okay. Assets. So is 8 million. Oh, just a minute. I'm coming. $8 million. So what is the capital allowance?
25%.
Let's check. How many percent? 25% reducing balance, written down allowance are available on the what? On the cost of the asset. Because it is reducing balance. Sometimes it may be on what? On straight line. Right? Sometimes it may be on what? On straight line method. If it is on straight line method, you don't need to reduce it, right? You still have the same capital allowance. So capital allowance, how many percent? 25. So what is the 25% in the first year? What is the 25% of 8,000? What do we have?
2,000.
You have 2,000. So you have to remove it to have your tax written down value.
Mhm.
What is this now? You have your tax written down value. This will be year one. Okay. So you have 6,000
Mhm.
as a tax written down value in year one.
Mhm.
Okay. Oh. So this will be what? 2,000 as a capital allowance.
Mhm.
So what is the tax savings? Tax savings will be 30% of the capital allowance. What do we have?
Yes, 600.
600. So tax due. Don't forget that it is in arrears. Year one we due in year two. Class. It is in what?
In arrears.
In arrears.
Arrears.
Right? Right. So year one we be due in what? In year
Year
two.
2.
Okay. So this is 2. Okay. We have year 2. Should I bring it capital allowance again? Okay. Let me just say that's written down value brought forward. 6,000 naira. So the capital allowance
15.
1,500. So
Tax savings
tax savings
450.
450. This will be year 3.
Year 3, yeah.
Okay, that's fine. So what is the tax written down value here?
45.
Madam, you don't calculate the answer before, because I don't understand the tax written down value. Tax written down value brought forward 4,500. The CA 25%. What is 25% of this?
1125.
1125. 1125. 1,125. So what is the start savings?
338.
337.5.
338.
338 to be due in what? In year 4.
4.
Right. So 4. Don't forget that they dispose the assets at the end of the project.
End of the year. Yeah.
And the asset is to last for 4 years.
4 years.
The project is for 4 years. What is the tax written down value here?
3375.
3375. So that will be the tax written down value.
Yes.
Brought forward 3375. Now let's quickly go back to the question.
Okay.
We have an asset. We have an asset. The asset is expected to have a residual value in year 4 price. That is, they've considered the inflation and all that. So that is why they have a residual value to be what? 2 million in year 4 prices. So therefore, at that last year that they disposed that asset, please, you don't need to charge capital allowance. Right? You just have to, you don't need to charge capital allowance, but you have to test for it. Are you going to have balancing allowance or balancing charge? So we can have sales. So you don't need to say capital allowance again. You just say, okay, sales proceed. That is the square value. Sales proceed is 2 million, right? 2 million. That is 2,000. Class. So do we have balancing allowance or balancing charge? Do we have balancing allowance or balancing charge?
Allowance.
Balancing allowance. You still claim capital allowance on this, right?
Allowance. Balancing.
Okay. So what is the difference? What is the difference?
1375.
1375.
I'm out.
Right? You still have balancing allowance 1375, which is your allowance. Then what is the tax savings? How many percent? How many percent? 30%. What is the 30% of 1375?
413.
413.
13.
413, and this will be due in year 5. So, are we getting it? Who is against me in this class? Oh, 27. Okay, that's fine. For me, are we still together?
Yes, sir, we are together.
Okay, that's fine. So, we can move ahead. So, let's quickly complete. Let me complete this one. We started from which adjustments again? I think that's all now. Sales, from sales, please screenshot. You can screenshot this variable cost, incremental fixed cost.
We need to adjust the inflation as well.
For which one?
Inflation.
It's not
For
general
which
inflation.
Okay. Ah, thank you. So meaning that all this cash flow here, or cash inflow and cash flow, your cash flow, whether it is inflow or outflow, is now in money term. Class is now in what? Is now in money term. And you're given the real cost of capital with the general inflation of 4%. Right? With general inflation of 4%. So therefore, we need to convert from real cost of capital to money cost of capital. So the question now is, how do we convert to money cost of capital? So money cost of capital, who can give me the formula? Money cost of capital equals to what? Can give me the formula, please?
1 plus R CC close bracket.
1
Open
plus
bracket. 1 plus R CC close brackets. 1 plus
CC.
general inflation minus close bracket minus 1.
Thank you. Makes sense. Minus 1. Makes sense. You can mute your mic. The RCC is given to us in this question to be how many percent? 10%, right? To be how many percent?
7.7.
7.7%. 7.7% is equivalent to 0.077, right? The high is the general inflation. What is the general inflation given to us?
4%.
That is 0.04. Then what do we have again? Okay, we are good. So therefore, money cost of capital is equals to 1 plus RCC 0.07. Please confirm if it is 0.07. Then we have 1 plus 0.04 minus 1. This is conversion of real cost of capital to money cost of capital. So what will be our DCF?
Let me see.
What
Zero
will be
point
our
one
0.12?
2.
0.12. That is 12%. That is 12%. Okay. So now you can now plot, you can insert everything here, right? Okay, should we do that now so that we'll go for break? Okay, I'm coming. Let me finish this. So after sales, what do we have? We have variable costs. So please give me a figure. You can screenshot all these things, right? This you can screenshot it, right? Okay. Our variable costs, I can say less variable cost. So what is the variable cost? Hello.
1,103. 1,103.
1,103.
1,158.
1,158.
1,013.
1,013.
851.
851. After variable cost, what do we have again?
That
Please,
tier one
please, for the
variable
first
cost
year, 103.
1,103.
103.
Okay, that's fine. Thank you. So what do we have in
Fees cost? Incremental fees cost.
fixed cost?
Yes.
Fixed cost. Right. What do we have? We have
473.
473.
496.
496.
521.
521.
547.
547. What do we have again?
I think we have.
No, we have to get our cash flow.
Okay. Then, okay. We'll apply our tax on our cash flow. Right. Can say cash profits before tax. So what do we have here?
4824.
What do we have?
4,824.
No, 5024.
5024. Next, what do you have? You can call it operating
5114. 5144.
5144.
44.
What do you have here?
4301.
4301. What do we have here?
And 3410.
3410. Please, the reason why we had this 5 is because of the arrears. It's because of the arrears. Okay. So what is the tax? Tax at 30% will be paid in arrears. Year 1 will be paid in year 2. Year 2 will be paid in year 3. Year 3 will be paid in year 4. Year 4 will be paid in year 5. Meaning that, look for what is the 30% of 5024? What is the 30% of 5024?
1507.2.
1507.
No, you said
So next
5024. Like the first.
Okay.
Next, what do we have here?
1543.
30% of this
543.2.
1543.
Yes, 0.2.
And leave the points.
All right.
Yeah, since it's just 2. If it is 5, we'll just make it 4.
Approximate.
Yeah. So what do we have here?
1290.
1290. So what do we have here?
Then 10323.
1,
103.
2, 3. Okay, so after the tax, we have tax savings. This is how we're supposed to present that first on board, because they didn't give us tax. So, they didn't give us tax, no tax there, right? So this one, we have tax savings in our workings. We go back and pick our tax savings. So you just need to give me figure. Can you see the tax savings? Can you see it, class? Can you see it?
Yes.
Okay, thank you. So
you have 600.
Year 2, right? It started from year 2, right?
Yes.
Okay, what do we have? 600.
600. 450.
450. What do we have here?
338.
338. What do we have here?
413.
413. So we have the sales proceed, which is the scrap value. Excuse me. Right? That was sold at the end of year 4. Right? After that, we have our assets, which is our investments. You can say our assets or investment at year 0 is 8,000. After that, we have working capital. So working capital at year 0, please. This is it. Can you see it? This is it.
You have 660. Year 0.
Okay, year 0. Okay, thank you. We have here to be 660, year 0. What do we have here?
Yes.
We have, what do we have?
20.
Negative 20. What do we have here?
20.
And next?
96. Positive.
Positive. What do we have here?
103.
103.
103.
What do we have here?
481.
481. Right? So that is that. Is there any other thing? Please don't put common mistake. Class, common mistake is that some student will bring this sales proceed before they will even put it here after the variable cost. They will not say they will still charge tax on sales proceed on an asset. Sales proceed that is on capital gains. Right? Sales proceed is on capital gain, is an asset. So you don't need to put your sales proceed maybe in your variable cost after your variable cost because you say, yes, it's sales proceed down. Then you now put it there. No. Sales proceed is capital gains. That is why you see that we didn't charge tax on it. Another thing is one other thing again. Which other one again? Yes, balancing charge. Of course, it will come after the fixed cost. If it is balancing charge, of course, have to tax it. You have to. So we have 30% on it. Okay. So So what is the MPV? What is the so what is
Sorry, sir.
the final
Sorry,
balance
sir.
now?
Sir, hello, sir. In that working capital, where
I'm
are we
with you.
now recouping it, sir?
We've done that.
Okay.
We've done that already. If you have 481 plus 103 plus 96, what do you have? Minus 20, what do you have? You have 660.
Yes, sir.
Positive. You have 660.
Positive.
This is
Yes,
positive
sir.
already.
Yeah.
This is your
Okay.
cash inflow. You've already incurred
Okay.
this. Is that not so?
Okay.
And you have
Okay.
this, you have this, you have this. Minus this, you have this.
Okay. I thought it's in year
But that
5
one,
that we
that
can't
other
get
thing,
to.
no, you know, that other question is just straightforward question. At year 0, then you keep, you know, that one is just straightforward question, you know.
Oh,
You
okay.
understand?
Okay, sir. Yes, sir. I do now. I do. Yes, sir.
Okay,
Thank you, sir.
that's fine. That's fine. You're welcome. So, so I think you can, okay. So what do we have here? What do we have? What do we have? What do we have? What do we have? Quickly.
8660.
So I think we'll just, I think what we'll do is
We
that
have
we can
660.
8
660.
8660. So we can end the class. We just end the class after this. Just hold on. Sorry, hold on. Then I have questions. Coming. Okay. Oh, we need to solve this question. Maybe that one will be on Wednesday. Okay. It's fine. Okay. So what do we have here? Year 2.
5004.
Okay.
5004.
5004.
Okay. What do we have here?
4333.
433.
So what do we have here?
3311.
Okay. 3311. What do we have here?
49319.
Okay. 49339.
39. Yeah.
Okay, next. What do we have here?
System in jacket.
Okay. Thank you. System. Okay, makes sense. So in this question, maybe we'll just end the class with this, right? So in this question, we'll just form a question on sensitivity analysis. So at least I will know I've covered that, but yes. So what else? This year, right?
Yes.
12%.
12%.
So this will be 1. So what do we have here? 0. What?
0.893.
0.893. Next.
0.797.
0.797. What do we have here?
0.712.
0.712.
0.
What do you have here?
0.636.
Okay, what do you have here?
0.567.
Okay. So what is the present value? This will be 8660. So what do we have here?
4469.
4469. What do we have here?
3453.
3453.
53.
Yes,
2
what do you have?
357.
2357. What do you have?
2357.
What do we have here?
3141.
3141.
1
What do we have here?
346 in jacket.
Okay. 346. So what is the MPV? Net present value. Net present value.
4,414.
Okay. That is 4,414,000. So what is the recommendation from the above analysis?
We have a
Right.
positive.
Yes, from the above analysis, the proposed investment projects will give a positive NPV of 4,414,000, indicating that the project will maximize shareholders' wealth. Therefore, the project should be accepted. We move. Class, are we good? Are we good?
Please, sir, can you help scroll?
It's a very
You said?
impactful lecture. Thank you. It's a very impactful lecture. Thank you, sir.
Thank you. Okay, Oga Kende.
Yes,
Right.
thank you very much, sir, for your time. I was saying that, can you please help scroll up? I just want to check something, actually.
Okay. So please take note of that recommendation. It's very important. The way you speak, professionally, when you are writing a report, it should show that, yes, apart from your professional skills, should show that, okay, this person knows what he is doing, right? So please, in that recommendation, add Jara, put plus and minus, just speak one small English and grammar there, then you move on, right? So let's quickly, so I will go.
Mr. Brian,
Sir?
if we are having a scrap value in the question, so that means we also deduct it after our working capital.
Scrap value is not deducted, is an inflow.
Okay.
This is it. You can say scrap value. Okay, let me use. Don't worry.
Is it not the same with that sales proceed?
No, let me use this.
Scrap value is better.
Okay, thank you. It's an inflow, right? It's an what? It's an inflow.
Okay.
Okay.
Thank you, sir.
Yeah, you're welcome.
Please scroll down your screen a bit, sir, so I can see the.
Let's see that computation of that capital allowance, sir.
No, you can check. Mukuna no disturb me. I beg.
Calm down.
Are we done so that we can go?
Calm down.
My blood is hot like this. My blood is hot. My blood is hot. Make we continue.
Mr. Ibrahim, are we done?
No, we need to continue because my blood is hot.
Continue to where? Here. By the time they bring one tough question, now everybody will be shouting, let's go.
I beg you, my blood don't cold though.
Please, so let's go for break.
Go and drink
We are going, not even break. We are going.
No. No, not even break. Honestly, not you guys have actually tried, right? Let's just perform a sensitivity analysis. Right. Once we do the sensitivity analysis, then we'll go. right? Right? We just go, please. Let's go the sensitivity analysis, right? Sensitivity analysis. That's where they ask me for capital allowance. Check YouTube, away. No disturb me. So, so just check the YouTube. You see that. So, the question did not say we should do sensitivity analysis, but I just want to okay, so that we know that I've covered the part of conversion of money to bill, the part of what is it called? Project duration. Yes, project duration. Now, sensitivity analysis. Don't forget, what is sensitivity analysis? Determination. Please, the question did not say we should do the sensitivity analysis. So, sensitivity analysis. Now, don't forget that I said sensitivity analysis is the changes in the variables. Now, let's assume that the question says that we should do a sensitivity analysis of maybe sales on sales, right? On sales in value or selling price, whether they tell you it is selling price or sales, right? It is still the same formula. What is our formula? NPV equals to present value. Present value of what? Present value of what? We
Present
present
value of sales.
Revenue.
Of revenue or
Revenue of
sales.
sales.
Anyone. Yeah, anyone times 100, right? So sensitivity analysis will be equals to the NPV is 414 divided by, right? What is the present value of the revenue? So we go back and check. It's a simple, what we'll do is that this is your revenue, right? These are your revenue. Is that not so? Class, is that not so? Okay, I will do something now. Come to see. Let me copy it from year 1 to year 4. Right. Sales equals to, this is it, right? This is it, right? I can do, so I can add this to, there are two ways you can get the present value, right? You can just put the DCF here. Then you have, the first year is 0. Let me copy this thing now. 0 point something here. Present value. You can just copy this. Okay, the last year. 1, 2, 3, 4. So, what is the present value? Multiply. What do you have? What do you have? B. So, what do we have, class?
5,894.
Okay.
5,894.
Just hold on. Sorry. Trying to set up. Just hold on. Okay. 5 what?
5,894.
5,894. Next, what do you have?
5,418.
5,418. Next,
4,155.
4,155. Next,
and 3,058.
3,058. So when you add everything together, what do you have? Total. What is the total of this?
We have 18,525.
Present value. 18.
525.
525 is a million. So we can have here 18,525. That is the sensitivity. Equals to what do you have? Times 100. What do you have?
23.8.
23.8. 23.8%. So what is the interpretation, class? Who will give me this interpretation? What is the interpretation?
Can I try?
Okay, please go ahead.
I think what this is saying is that we are going to achieve positive MPV, and the project will be worthwhile for as long as the revenue for as long as the revenue does not fall beyond 23.8% of the current amount.
Thank you. Right, thank you. In addition to that, you can see, okay, from the above sensitivity analysis of sales, right, resulting to 23 points. Don't mind me, I'm just using the language of analysis, like the way I normally do my analysis. You can just put it the way you understand, right? Contributing to or resulting to 23.8%, right, indicating that the sales should not drop or should not decline more than 23.8%. If not, the MPV will become 0 or negative. Then we move from there. Thank you so much. And please don't forget that if you go for an interview and they give you a case scenario, that maybe as a project finance officer, they give you a case scenario and you analyze it to prepare to do MPV, and they give you internal rate of return to be positive. When your internal rate of return is positive, definitely your MPV should be positive. All right? Your MPV should be what? Positive. So please take note, because there's no how you will have internal rate of return to be like 8%. How do you arrive at the internal rate of return? Is it not positive or negative MPV? It is, right? It is. Thank you. So,
Yes, Mr. Ibrahim.
yes,
Please just
ma'am.
a quick one. Like in that the DCF for the sales, can we use annuity of, since it's the
Yes,
same year from one
yes,
to
yes. That is what I want to even say. That alternatively, you can use annuity from here. That is what I will use for the fixed cost. Then we'll go. That is what I will use for the fixed cost. You can use annuity. Just do your annuity from year 1. Annuity from year 1 to 4. Please, is year 1 to 4. Annuity from year 1 to 4. Then multiply it by the total sales from year 1 to 4. You have your present value of revenue. Thank you. That's a very good. So that is the method I will use for this part. Then, so I will go right. Lastly, don't forget, if it is cost, you should not allow the cost to increase. If not, what will happen to the MPV? Becomes 0. Right. So let's quickly perform a sensitivity analysis on these so that we can go right. Oh, okay. 414. Okay. Divided by, what is the present value? What is the fixed cost? So please, what you will do, add the total fixed cost. What is the total fixed cost, please? What is the total fixed cost? What is the total fixed cost?
2037.
Okay.
2037.
2037. 2037 times, what is the DCF from year 1 to 4? Do your annuity. Annuity from year 1 to 4. What do you have? Or you can add all these things together. You can add
3.037.
3.037.
Yes.
Okay, so therefore, sensitivity analysis of 414 divided by, what do you have here? When you multiply, what do you have?
6,186.
6,186.
186.
Yes. So what do we have? Times 100. Don't forget it's a million. What do you have?
71.4%.
71.4%. So thank you. So we can analyze this.
Mr. Abi, sorry. Please, in doing for fiscal, so there is no need to consider the tax saving, right?
No.
Okay.
Oh, the tax, right?
Yes.
No. If there is, maybe in our next class, I will check. But no. Do you get? No.
It's all right.
We'll still continue to be doing sensitivity analysis as we move on. Right? I will keep on assuming that. Let's assume there is sensitivity analysis. We'll keep on performing sensitivity analysis on every MPV question that we solve. Do we get? Are we good?
It's all right. All right. Thank you.
Okay, thank you. So for those who are just joining us for the first time, my name is Mr. What is my name, self?
Forgotten your name.
Mr. Ibrahim.
Mr. IB,
So,
Mr. Ibrahim.
So you're welcome. Let me quickly welcome you, right? To next gen professional associate. So you can check the YouTube, check videos that we've done so far, right? And for those who are here to get your material, please get your material because I'm still working on. I'm doing research on option pricing, right? Option pricing is another. If you look at the syllabus, they emphasize on that option pricing. And it will not be the usual option pricing that we used to know. The usual option pricing we used to know, we do the what is it called? The call up option, the put option, blah blah blah. Now you need to have what we call payoff table. You need to have payoff table. You need to have what we call put to call parity. You need to have what we have abandonment project and all that. So I'm working on a research on a comprehensive note on option pricing. So that is why the material, right? The value of the material, the amount said the price said is even less than the value of the material. So I expect everybody to get the material, right? So thank you so much, everyone. Do you have anyone that have question before we go?
Can you take it back to that capital allowance?
Okay. Next question.
Hello, sir.
Next
Please,
question. Yeah.
can I get the link to the YouTube videos for the previous class, the previous lectures?
Yes, you can just check on YouTube. You can just search for next gen. But then I will do that shortly now, maybe after the class.
Yeah, please.
Okay, thank you, sir.
Please, Mr. Ibrahim.
Sir.
Please, I was not around when you are taking bonds, but I was now like going through the video. I have some questions I want to ask. Maybe I will send this to the group, please, so that you can
be able to send it to the group and tell people where did the group, may they help you. Then later I can.
No, it's not like it's a kind of it's not so maybe when I say so you will understand. So anybody can also.
Okay, I'll tell you. Okay, that's fine. That's fine. So we are good, right? So thank you so much, everyone, for joining.
Please, I'm sorry, sir. Is that
I won't go to one there. They don't.
I know, sir. Is that fixed cost that I'm still looking for? How we got that to 237?
What is that? 20? Which one you?
The fixed cost, sir. The fixed cost. I'm looking for the figure. How we got arrived at that figure.
Well, you understand that we. But you understand how we get these sales? You understand how we get these sales?
Yes, the total of that sales.
The same approach. Use the same approach.
No, I mean the total.
This is the total. Add 473, 496, 523, 547. Add it. What do you have? You have that figure now. Madam V, Madam
Hey, so
Victoria.
go down to sensitivity analysis. Let me.
Okay. Madam V.
Yes, I want to ask, this material for capital budgeting, is it uploaded on the Google Drive? Because
Yes,
I can't
it's there.
No,
check capital budget. Is there?
It's there.
All right.
It's there. It has been updated. It's there. The old one, just check it. It has been updated.
Thank you.
Thank you. So thank you so much, everyone. And
thank you, sir.
Have a lovely weekend. We did weekend already now. We go do one day. Bye-bye. Thank you so much, everyone.